I'm introducing the Amplify Energy team. Amplify Energy is an upstream company focused on the acquisition, production, and development of oil and gas properties in the United States. Their properties consist of mature, legacy oil and natural gas fields. They are focused on maintaining production across their high-quality asset base and executing on their strategic priorities. Amplify Energy is headquartered in Houston, Texas. Speaking for them today is their president and CEO, Martin Wilshire. Martin?
Thank you, and good morning, everyone. I'd first like to start by introducing a couple of members of my team here with me today. Jim Frew, our CFO, and Michael Jordan, our treasurer, are joining me today. Before I get started, before we start flipping slides, just want to talk a little bit about what Amplify is and what it's not. You guys have heard probably a lot of presentations from companies that are in the shale business talking about their big drilling programs and they're needing to maintain the constant rigs running in order to kind of maintain production. That's not Amplify. Amplify is a collection of fairly evenly sized operated assets across multiple basins, which are much more mature, need far less kind of capital to kind of maintain that same level of production. So over time, the plan is to kind of maintain a similar level of production, similar level of free cash flow, and kick that back to investors over time in the form of capital returns, which are to be determined. I'm going to flip ahead, and I'll come back to the slide before this, but wanted to start by just talking a little bit about where our assets are located. We'll start with in order here. Oklahoma, up in the northwest part in the Mississippi Lime area. This is an area that we inherited as part of a merger with Mid-States Petroleum back in 2019, late 2019, right before the pandemic. This is an area that's partially oil, gas, NGL, so it's an area that we've tried to maintain mostly flat with just workovers. We're not actively developing the area. There is some upside to the area, but we're very conservative in what we choose to drill and not drill, unless pricing reaches a level that we are extremely comfortable with the upside opportunities. Like I said, we are very comfortable kind of maintaining regular, steady production using just workovers and changing a lot of those wells that are on ESP to things like rod lift or to lower operating costs over time. So that's Oklahoma. Number two is a place called Barrel, Wyoming, where we have a legacy CO2 flood. This has been on tertiary CO2 flood for 40 years. It is a almost entirely flat profile at this point. I think in the reserve report, I think it declines around 4% a year, but just with some maintenance and managing of the wells, you can pretty much keep that flat for the long time. This is an area that, it's a little bit higher fixed cost, but it is an area that has enormous potential, especially at kind of oil prices where they are right now in order to kick off a lot of free cash flow. Area number three is our Southern California asset that we call on here. This is a beta field. It's offshore Southern California. It's actually an incredible field. If this was onshore in a different state, we would be touting this to the high heavens. This is a huge field where there's abundant oil remaining in place. And prior to a couple of years ago, we were kicking off a development program out here. And then unfortunately, there was an incident involving cargo ships hitting our pipeline that has kept us kind of from producing for roughly about a year and a half. We brought this field back online in late April of this year. We've been ramping up production steadily and expect to hit full production from this field either late third quarter or early fourth quarter. So this field is almost back to full production and is looking good. We're now considering whether or not to kick back off that development program, which I'll talk about a little bit more in a minute. Area 4 is kind of our legacy East Texas. This is your Cotton Valley, gas fields, great pricing, close to hub, lots of takeaway capacity. We do have some upside in areas like the Haynesville and the Bossier, but this is primarily a Cotton Valley play. This has kind of been our base asset for as long as Amplify and its predecessor have been in business. So, for the last 10 years, we've kind of gotten really, really good at operating this asset. And then number 5 is the only shale play that you'll see on here. It is in the heart of Karnes County. It is a fantastic position. We just don't own enough of it. This is with Murphy as the operator in the heart of Karnes County. So generally we own between 5 and 20% of the properties, depending on where they're drilling and what they're drilling. So I'm going to slip back a little bit and then talk about from here. So where are we and where are we going? So like I said, Amplify is a free cash flow generating company that has really, dedicated itself to being kind of a yield focused company. Long before that was everyone else's plan as well. Said this is a largely mature area. We'll talk about declines in a minute, but we have probably the lowest decline of any public company on our base assets in the entire space. We've had obviously with Beta being offline for roughly 18 months, that set us back a little bit, but with it coming back online and coming back to full production, the option set in front of us is significantly enhanced. And going forward into next year, we're going to have a lot more options about returning capital to shareholders and really looking at the portfolio and deciding what's the best kind of process to move forward with the assets we have. We also just refinanced our credit facility. As you can imagine, while one of your major assets is offline, it wasn't the best time to have an expiring credit facility. And then we went to do it, and obviously that was when the regional bank crisis hit. So luckily, we pulled through and kind of pulled together this credit facility, which we're very happy with. As a free cash flow generating company, we just need enough capital to kind of keep a nice little working capital line. We're going to be paying this down steadily over the next 18 months and should be, relatively debt-free by sometime in 2025. Then again, that probably is not going to be the plan. I think long-term, we'll probably stay between half a turn and a turn of leverage and return whatever's left to our shareholder base over time. We are down from 1.8 times to 1.2 times as of the second quarter. This is going to, like I said, steadily reduce over the next 6 to 12 months to be almost nothing by the time we get around to the end of 24, beginning of 25. At some point over the next 12 months, I anticipate beginning a capital return program. The form to be determined, whether that's buybacks, dividends, or some combination thereof. But that's what we're anticipating over the next 12 months or so. Moving on, I want to talk just a little bit about ESG profiles. Everyone has their ESG slide. I'm going to touch on a couple of things. First and foremost, the most important one on here is what we're doing in California. This was delayed a little bit, but we are basically taking all of our electrical generation equipment and basically eliminating all diesel and other emissions from those platforms. So going forward, not only does this provide a standard for those platforms where there's basically no emissions coming from any of the generation equipment. We don't have to use any diesel. We'll just use gas and shore power. And then secondarily, you're no longer paying the expense of emissions credits, which we also have to do. Over time, this is probably a $7 to $8 million a year type of savings that should be implemented kind of starting later in this year and going forward into next year. So it's going to have a big reduction in kind of the operating costs. And for any of you that are familiar with areas that are, higher fixed costs, which are, platforms are mostly fixed costs. This is going to make a big difference in kind of the long-term fundamentals of the field. It's also going to make developing that asset that much more accretive. We have rigs on both platforms that allow us to develop the asset ourselves. We don't need to mobilize or demobilize anything. So anything we drill, is obviously a lot cheaper for us than it would be for anyone else. And you can drill some really interesting wells out here, and for a fairly cheap amount, call it $5.5 million on average, that are going to deliver 400,000 or 500,000 barrels of oil. And at the same time, we're going to be able to do that at a lower cost, and then with minimal incremental operating costs of $4 to $5 a barrel. So you can imagine in a $70, $75 oil environment, what bringing on a new production with a $70 margin does. You're talking about returning your capital in less than a year, and maybe even 6 months. And at the same time, this is an area where the development can go on for a long, long time. As part of the process of what we went through, we have tested the platforms, we have tested the pipelines. It's actually all in immaculate shape. We have tested this pipeline. The maximum allowable operating pressure is around 1,000. We went up to 2,500 PSI without any problems whatsoever. The only issues this pipeline's ever had is a result of the ships that hit it in the first place. So after replacing those pieces of the pipeline, we've got every confidence this pipeline is going to be good for the next 100 years if we need it. So, like I said, it's a great opportunity. Uh-oh. There we go. Did I skip the slide? Sorry, having some equipment issues. Talk a little bit about the valuation upside here. We trade at a relatively low price compared to kind of the value of just the existing reserves. This doesn't include anything for that beta development. It doesn't include anything related to those operating cost reductions that I'm talking about. This is just based on existing reserves and existing prices. And so you can see that there's tremendous value potential just from the base assets. And once we layer in the operational efficiencies we expect to be able to do over the next 6 to 12 months, plus the development program we're hoping to kick off by the beginning of next year, there's a lot of upside to the price of this stock, and we intend to bring all that to, through our shareholders over the next 6 to 12 months. Hopefully it starts working. So we'll talk a little bit more. Sorry, this is. Can somebody advance the slide? This is, oh, there we go. So wanted to kind of touch on this point a little bit more. Like I said, if you look at us versus our peer group, and really us versus just about anyone, if you look at the larger companies, they're all very shaly, and it's not going to be anything like this. We have a much longer life, a much lower decline on average than just about anyone. What that leads to is that we don't need a whole lot of incremental capital to hold this flat. It's a 6% decline on average over the next 10 years. Just a little bit of incremental production, a little bit of incremental capital can hold that relatively flat, which means you can hold free cash flow flat. If you layer onto that a little bit of growth projects, like I said in beta, then you can slightly increase production, but you're significantly enhancing free cash flow. And that's really what this company is all about, is managing free cash flow. We don't worry about, production's not the main priority. It's really that free cash flow line and what we can ultimately distribute back to our shareholders that's most important to us. Oh, there we go. Just another example, for the last 2.5 years, we went through a pandemic, and then we went through a time when one of our main assets was actually offline. And despite that, besides one quarter where we were just slightly below, we've managed to maintain free cash flow through all of that period. And like I said, beta was offline until late April of 2023. So from fourth quarter of 21 through April of 2023, we still had positive free cash flow. We were still able to manage the full portfolio of assets and generate significant free cash flow despite that main asset being offline completely. This is a testament to kind of the strength of the portfolio of assets, and really, like I said, with beta coming back online, it demonstrates the free cash flow potential moving forward. We are projecting $30 to $50 million for this year, but upwards of $200 million over the next 3 years, including this year. So that averages out to around $80 million a year for 24 and 25. This doesn't reflect all the cost savings or the ability to develop beta. So there's incremental upside to that as well if we are able to reach our goals. So in wrapping this up a little bit, really want to talk about, like I said, for the last, 18 months, we've been dealing with the impact of the beta situation. I'm happy to talk about that as much as anyone wants in the breakout session. But really, that's really been our focus, is trying to get through getting that pipeline fixed and getting the beta facility back online. It was an arduous process, but we were able to do it and get everything back online in April of 2023. Now that that's done, the new credit facility is done, it's really time to focus on kind of the strategic direction of the company. That's going to include, like I said, developing beta, the option to develop beta, the decision on what assets do we want in our portfolio long term? Do we want to, we've got 5 different assets and 4 different operated assets spread out across the country. We have the optionality to potentially move some of those assets around and optimize potentially 1 or 2 of those assets and focus our attention on some of the assets where we think we're going to grow longer term. Those are the decisions that are kind of right in front of us now, and decisions that I think we're going to be kind of ready to start announcing to the investing public by, call it Q4 in our third quarter earnings call. Like I said, we've got a huge amount of equity valuation upside just at an existing base assets once we implement the cost savings and the incremental development plan, which is not, and we have basically no PUDs involved in our reserves. Once you start seeing the impact of that, it's going to have a significant impact on that ultimate share price as well. And like I said, then we've already got $200 million of free cash flow built into the forecast with the option to create a lot more value for shareholders as we go forward now that we're kind of behind the events of the last 18 months. And with that, I will say thank you to everyone for attending today. Appreciate your time and hope to see a lot of you in the breakout session. Thank you.